So one of the most important contributions of Kahneman and Tversky is this prospect theory. Prospect theory fundamentally changed the way people thought about some basic ideas in economics. So the conventional view, let me show you the graphs here on the next slide. Um, so this is a plot of wealth against utility, right? So this graph is basically showing how much utility do people derive from wealth, right? So utility in simple terms, you can think of utility as satisfaction, right? So the more wealth one has, the higher is the degree of satisfaction. But this is not linear, right? I mean, this is actually uh, concave, right? In this case, so for example, what this means is that if somebody has a high amount of wealth, is very wealthy, an extra dollar of wealth is not going to matter that much to that individual. That will not provide as much satisfaction or utility versus someone who has a relatively smaller amount of wealth, right? So an extra dollar of wealth gives a much higher utility to someone who has a low wealth versus someone who has higher wealth, right? So this is what we call in economics as the diminishing marginal utility of wealth, right? Marginal meaning incremental, right? How much utility does extra dollar of wealth provide? And as the wealth increases, the utility, it diminishes, right? So you can see that in this graph. I mean, going from say 15 to 20, right? The increase in utility or satisfaction is not as much as it is from going from 5 to 10, right? So there is a higher increase in utility when you go from 5 to 10 versus when you go from 15 to 20, right? So it's the same increase in wealth provides a lower satisfaction at higher levels of wealth, right? So this is diminishing marginal utility of wealth. And this concave utility function here is also consistent with what we refer to as risk aversion, right? So we have talked about risk aversion before in class. Concave utility is consistent with risk aversion. Why? And you can see here, let's say you start with 10 here, right? So $10 going from 10 to 15, you have a gain in utility. Going from 10 to 5, you have a decline in utility. However, this decline in utility is a lot bigger in magnitude versus the gain in utility. So a $5 increase in wealth does not lead to that same magnitude of increase in utility as you would have from a $5 decline in wealth, right? Going from 10 to 5, the loss in utility is bigger. Going from 10 to 15, the gain in utility is relatively smaller, right? So that means people don't like losses, and when you have risk, there is always a possibility of loss. So that's the idea that uh, concave utility function is suggesting that people don't like risk because risk can lead to the possibility of loss. So this is consistent with risk aversion. So what the conventional view is saying is that people are always risk averse, right? People are always risk averse. So that's the conventional view in economics, a long held view in economics. And then there is this prospect theory view. So this view is based on experimentation. So Kahneman and Tversky, they conducted a number of experiments, and based on that experimentation, they arrived at this S-shaped utility function, right? So let me actually give you couple of examples of the type of experiments they did. The numbers that I'm going to show you are the actual numbers they used in their experimentation. Okay, so let me go to the whiteboard here. All right, so suppose you are given two choices, right? So choice A and choice B. These choices, by the way, are known as prospects, hence the name prospect theory. So choice A, uh, you make $4,000 with 0.8 probability, okay, and you make nothing with 0.2 probability. All right, so that is your first option, choice A. Let's put that here. Okay, choice A. If you choose this option, there is a 80% chance that you will make $4,000, but there's a 20% chance that you will make nothing. Okay, and then let's look at a second choice, choice B. Here you make $3,000 for sure. So this is 100% chance of making $3,000. So you're given these two choices. Again, with A, there's a 80% chance of making 4,000, but there's also 20% chance that you will not make anything. If you choose B, you will be just given $3,000. That's guaranteed payment. Given this choice between A and B, which one would you choose, right? So that was the experiment that Kahneman and Tversky did, and most of the people, a majority of people chose B. In fact, I have some numbers here. 80% of the people in the experiments chose B, only 20% chose A, right? So this is the first experiment they did. Now let's uh, do one more calculation here. Let's look at another experiment here. So we can probably put that on a different whiteboard. So let me see. Okay, so in this experiment again you have two choices, choice A. Now these choices are framed in terms of losses. So in the previous case you were making money, now you're looking at losing money, right? So uh, choice A, lose $4,000 with 80% probability, and lose uh, lose nothing with 20% probability. Okay, so that's the first choice. And then choice B, lose $3,000 for sure. Okay, so same numbers, but now we are looking at losses instead of gains, right? So if you choose A, there's a 80% chance that you will lose $4,000, but there is also a 20% chance that you will lose nothing. But if you choose B, you will lose $3,000 for sure. Okay, again, subjects in the experiment were given these two choices, A and B, and they were asked to choose. And in this case, majority of subjects chose A over B. In fact, 92% of the people chose A, only 8% chose B. Okay, so what do these experiments tell us? Let's go back to the first one. right? So this choice here we said that majority of people chose B. Why did they choose B? They chose B because that was a guaranteed payoff of $3,000. But this choice is actually inconsistent with the conventional view. The conventional view in economics is that people would try to maximize the payoff. What is the expected payoff of A? 0.8 times 4,000 plus 0.20 times 0, and that is how much? 3,200. What is, and what is expected payoff of B? That is of course $3,000, right? So do you see how we get this expected payoff? 80% chance of making 4,000 and 20% chance of making nothing. So 0.80 times 4,000 plus 0.20 times 0, that is 3,200. And with B, you're making $3,000 for sure. So in this case, a payoff of A is higher than payoff of B. Conventional view is that people try to maximize payoff. So the conventional thinking is that people should choose A, not B, but the actual evidence from experiment showed that majority of people chose B. What is this choice B telling us? It's telling us that people are risk averse, right? People don't like to take risk in this case. So when they are offered this sure payment of $3,000, they took it, even though in choice A, there's a very significant probability that they would end up making an extra $1,000, right? But they did not want that. So people are showing risk averse behavior in this case, right? And that is inconsistent with conventional view, which says that people should actually be choosing A here. What about the other experiment in which we had uh, losses? Let's actually look at that one. So let me see if I can copy that. Okay, let's actually go to that one. Okay, so this is with losses, right? So in this case, we said that the preferred choice was B. Now if you compute the expected payoffs here, so in this case, there is a 80% chance of losing $4,000. So we'll use negative 4,000 here, and then 20% chance of losing nothing. So the expected payoff is a negative 3,200. What about expected payoff of choice B? Well, of course, there in this case, it's the guaranteed loss of $3,000. So expected payoff is minus 3,000. So it's negative 3,200 for the first one, choice A, and negative 3,000 for choice B. Which one is bigger? Negative 3,000. So conventional view is that majority of people should, or most people should choose B over A because its payoff is higher, and yet the experiment reveals that majority of people choose A over B. What does choice of A reveal here? Is that risk aversion? No, it's actually risk-seeking behavior. People are willing to take chances here. Even though there is a 80% chance of losing an extra $4,000, people actually take that choice versus a guaranteed loss of 3,000. So there is a very high chance that they would end up losing an extra $1,000, and yet they choose that option, right? So this is showing a risk seeking behavior. Here people actually are taking the risky option, right, versus the gains case where people were actually taking the guaranteed option. So they were showing risk uh, aversion in case of gains, but they are showing risk seeking behavior in case of losses, right? So that is your conventional prospect theory view. uh, so the conventional view is that it is risk aversion, but the prospect theory view is that when people are looking at gains, they have risk aversion, right? So in this part, remember here the x-axis is different. Here it is change in wealth, meaning on this side of zero, on the right hand side you have gains, and on the left hand side you have losses. When faced with gains, people show risk averse behavior, right? So that is similar to the conventional view. But when facing losses, people show risk seeking behavior. So now your utility function is convex. So concave over gains, risk aversion; convex over losses, risk seeking behavior. Overall you get this S-shaped utility function under prospect theory, right? So this is what the experimentation show, and this is what prospect theory. So you can see here uh, that this is the alternative view in which what matters to people is gains and losses, not the absolute level of wealth, and how they behave over gains and losses is also very different. All right, so prospect theory is basically a new way, a newer way of looking at how people derive utility from wealth. Okay, that's the Kahneman and Tversky's prospect theory. So prospect theory and mental accounting together have been used to explain what is known as disposition effect. Disposition effect is another behavioral bias, and if you have traded, you might have experienced this. Disposition effect is the tendency to sell the winning stocks too quickly and hold on to your losing stocks for too long. If you have a profit, you take that profit very quickly. If you have a loss, you have the tendency to just hold on to that losing stock for too long, perhaps with the belief that it is going to recover at some point, right? So tendency to sell the winning stocks or winning investments too quickly, tendency to hold on to losing stocks for too long, that is what is known as disposition effect. A very pervasive bias, disposition effect, has been observed amongst mutual fund managers, amongst traders in future markets, amongst individual investors. So it is very pervasive, not just limited to retail or individual investors, but also mutual fund managers and professional traders. Okay, another behavioral bias. This is the disposition effect. So far we have looked at various behavioral biases and how they can potentially lead to mispricing, thereby leading to patterns like momentum and post earnings drift and 52-week high effect and so on, right? So one of the critiques of this behavioral viewpoint, which is actually a valid critique, is that if these behavioral biases are causing all this mispricing and all these return patterns that we see in the data, why don't smart investors take advantage of this mispricing, right? So it cannot be that everybody is irrational. There must be some smart, rational investors out there. In fact, there are many investors out there, hedge funds and mutual funds and so on, who are actually looking for these type of opportunities, right? So they should be able to capitalize on these mispricings, and therefore this mispricing should disappear from the data. They should not persist, and yet we see that many of these patterns continue to survive, right? So that is the critique, that if behavioral biases drive this mispricing should be taken advantage of, but it does not seem to be the case. So the behavioral viewpoint, the behavioral field has to come up with a response to this critique, and the response can be summarized under what we refer to as limits to arbitrage, right? What is limiting the arbitrage? What is deterring the smart, rational investors from taking advantage of mispricings that are created by irrational investors, right? So these are some of the potential reasons for why the smart, rational investors might not be taking advantage of mispricings to the fullest extent, right? So the first one is referred to as fundamental risk. Okay, fundamental risk. So think about possible scenario, an example like during the dot-com bubble, right? So if somebody thought in say late 1999 that all these technology stocks were overpriced, well, that investor would have been right. But if that investor had acted on that viewpoint, right, if that investor had shorted the technology stock, that investor would have potentially lost a lot of money, because even though those stocks were overpriced at that time, they kept going higher for another few months, right? They went up by another 25% until the bubble burst in year 2000. So basically, it is not enough to say that a security is underpriced or overpriced. You need to be able to uh, time the the security, right? You need to be able to time the market. You need to be able to say that this is the peak and now it will go down, or this is the trough and now it would go up, right? So uh, if uh, if you think something is overpriced, does not mean that the correction is imminent. The overpricing can actually become worse. The security might keep going higher, and your investment horizon may not be long enough to actually stay invested in your position. Similarly, if you think something is underpriced, that does not mean that it would go up right away. It could keep going lower and lower before the correction happens, and again, you might not have the ability to hold on to that security for long enough. So that is the fundamental risk. It's basically the risk that mispricing can become worse, at least in the short run, and despite being right, you might actually end up on the losing side. Then you have noise trader risk. So noise trader risk kind of related to this idea of fundamental risk. The noise traders are traders who basically trade on whims. They are not following any particular systematic trading strategy. They might be buying or selling on hunches. They are not using any sort of fundamental analysis or technical analysis to pick their securities. So if you have a stock that is dominated by noise traders, right, then noise traders are going to dictate how that stock performs, and that is especially true for smaller stocks, right? And noise traders are unpredictable. I mean, you might be right and you might think that a particular stock is underpriced, but if that stock is dominated by noise traders and they think it is overpriced, well, the stock is actually going to go down and it's not going to go up. So despite being right, again, you might actually end up on the losing side. So that is noise trader risk. Then you have implementation costs, like for example, some cost associated with implementing your strategies. If you think something is overpriced, you will need to short sell. Short selling is costly, it requires additional fees and so on, and the fees might be uh, big enough, your cost might be big enough that you might decide that it is not worth taking advantage of that mispricing. So then that mispricing might persist. And then finally you have the model risk, right? So this one is basically saying that how can you be sure that something is mispriced? I mean, you are using some sort of a model, some sort of an analysis to identify a security that is underpriced or overpriced, but there is always a possibility that your model is incorrect, right? So your model might tell you that a security's fair price is $50 when currently it is trading at $40 per share. So you're basically thinking of buying that security. But what if your model is wrong and the actual price of that security is only $30, right? So in that case, because of this risk that your model might be incorrect or inaccurate, you might actually end up losing money. So because of all these different reasons, rational investors might not take advantage of mispricing to the fullest extent, and therefore mispricing might persist for a long time. So this is the response of the uh, proponents of behavioral finance as to why this mispricings don't go away, why they are not arbitraged away, right? So these are referred to as limits to arbitrage arguments, right? Fundamental risk, noise trader risk, implementation costs, and model risk. All right. So there are two sides of behavioral field basically. One is talking about all those behavioral biases and how they can lead to mispricing, but the other side is also about this critique, why the mispricing is not arbitraged away, and providing an answer to that critique is also part of this behavioral field. Okay. So that concludes our discussion on behavioral finance. There is this some of the material that you see on the slides is from chapter 9, section 9.1, but there is additional stuff on the slides that is not in the textbook. So when you're preparing for this material, make sure you use your textbook reading in conjunction with your PowerPoints and notes from the lecture. Okay, so that concludes our behavioral finance discussion. Next time we are going to get started with options. All right, so that will be chapters 15 and 16.